Good morning, good afternoon, everyone. My name is James Bogart. I'm CEO and President of Bogart Wealth. Today, we're going to be doing our retirement planning timeline presentation. I do have our Q&A box open as well as the chat box open. I will do my best to answer questions as I'm going through the presentation. A couple other quick administrative things at the end. We've added a survey, so would love to get feedback on the survey. And it'll also forward you over into a listing of all of the other events that we're hosting. Just to get going, by way of quick introduction, Bogart Wealth's what's called a registered investment advisory firm. We are fully independent. We are a fee-only firm. We're managing about $980 million of client assets now. It's about 700 households. About 90% of those are ExxonMobil households. We are true fiduciaries for our clients, which means that we're legally obligated to put our clients' interests above our own. I would honestly say any advisory firm that you're considering talking to or working with, they really do need to be true fiduciaries. We have 15 folks on our wealth management team, as well as 4 on our tax planning team. We've got 3 office locations, one up in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Many of you have attended one of these before. You know, I like to say it, but it's very true. Your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give them access to certified financial planners. You know, and the question I ask very commonly is, what would you do differently now that you know what you know, but back in your 20s? And one of the calls to action from any of these events is to sit down and run your numbers. One-on-one financial strategy sessions that we offer, they are absolutely no cost, absolutely no obligation. Great way to understand kind of where you're at, get a baseline, and potentially also learn a little bit more about our firm and how we can help. So today's talk is part of our retirement readiness series that we put on. We've been doing webinars basically every week since COVID started. But these are part of a series that we were doing live prior to COVID. But today's talk, as you know, is the retirement planning timeline. We do one on retirement income planning, which is actually the one that we're going to be hosting next week. I do one on Social Security and Social Security strategies, one on tax planning and tax law changes, one on estate planning strategies, one on net unrealized appreciation and post-retirement strategies, one on long-term care and long-term care insurance. And then last but certainly not least is our Roths versus traditional 401ks and IRAs. We have been adding new topics as things have been developing, whether it was the Secure Act or the CARES Act. We've been also adding different topics based upon things that people are asking. So if there's something that you'd like to hear us talk about, please feel free, send me a note or any one of us a note and let us know. And we're at a minimum delighted to add it to an existing presentation. All right, so I'm going to get started on today's talk. And today's talk, we're going to break down the timeline itself, some of the things that you need to be thinking about from a retirement planning perspective. I do like to start with kind of over a year out. Now, that doesn't mean it's necessarily over a year out in some people's case, but things that we need to be talking about then. I will transition to talking about within a year at retirement and then immediately after retirement. And it will seem like I'm talking a lot about the over a year out, but a lot of it does come in conjunction. Oh, and I am recording this, so it will be available for you to watch again, or any of your friends or colleagues who you'd like to share it with. Please feel free to pass it along. All right, so when we're over a year out, this is when we really want to start with understanding what are the rules of the different programs available to you, whether it's your pension program, tax rules, 401ks, etc. We also want to understand your investment choices. So what options you have available to you, whether it's within your 401k plans or anything that's outside of that. And if you haven't done it, run the numbers, have a financial plan. You know, I'm a firm believer it's never too early to develop a financial plan. We prefer almost to be talking to folks when they're in their 40s, because if we need to be doing any type of course corrections, that's when we can actually have an impact. It's a little harder to improve a financial plan when we're 60 or 90 days out, if we need to do that. When we're over a year out, we want to evaluate contributions. We'll talk about some different strategies today. And also consider hiring an advisor. If you're actually thinking about having an advisor in retirement, you might want to have a trial relationship with them. It's something that we're real keen on. I know a lot of other firms are as well, but test them out before you're making the big decision. And I think that's important. All right, so let's start by talking about some of the rules. And so we're going to start with talking about the pension program, and I'm really specifically talking about the ExxonMobil pension program. And a lot of it is based upon the what's called the discount rate for the lump sum. So with the ExxonMobil pension program, you have the option for a lump sum, you have the option for an annuity. A lot of folks lately with interest rates coming down are really wanting to discuss what discount rates are doing to be able to talk about having that lump sum option. Now, the discount rate is determined by your benefit commencement date. So the benefit commencement date does not have to be your last day of employment or retirement date. It can actually be a date that's much later in the future. It typically is, though, selected the earliest possible benefit commencement date. Now, if you're in the grandfather category, you actually have the ability to determine which quarter you're going into, whether it's for example, the fourth quarter or the first quarter, dependent upon the sequencing of the date. Now, I'll talk about the two different categories here right now. So in 2006, the Pension Protection Act was established. And what this was doing was it was specifically targeting companies that were offering a lump sum option to their pension program. It defined the discount rates that can be used. It also defined the actuarial table to be used. It clarified that non-spousal beneficiaries can do rollovers. It also clarified that after-tax balances can be rolled over into a Roth IRA. It also clarified that company match can be diversified. So many of you might have known that in order to get the extra 1% on the match for the ExxonMobil 401k, prior to 2006, it had to all go to stock. After the Pension Protection Act, they kept it at the 7% match, but you're now able to diversify your options. And also, it defined IRA and 401k contribution limits. All right, so I want to talk about the two categories of individuals first. I've had a couple questions come in. I'll make sure I get them. But within the ExxonMobil benefit program, there's what's called the grandfathered category, and then there's the non-grandfathered or everybody else. Now, the grandfathered category, you had to be over the age of 50 at the end of 2007 with more than 10 years of service prior to January 1st, 2008. Now, for this group of individuals, all of the old rules apply. Another way of translating that is you were 55 and had over 15 years of service by December 31, 2012, or you were born prior to 1958 and hired before 1998. Now, for this grouping of individuals, the math is actually very, very simple. We take 95% of the 30-year Treasury rate and they round to the nearest 0.25. So for this category, it's only based on the entire quarter of the previous quarter determines the preceding quarter based upon whatever the 30-year Treasury rates are doing. Math is actually very simple to follow here. We do know that the third quarter discount rates were at 1.75. We know that the fourth quarter discount rates have now been officially announced. They went down to 1.25. And all projections are showing that the first quarter of 2021 is going to be about 1.25 as well. Obviously, we're only 3 weeks in here into July. We've got the rest of the quarter, but I don't see a tremendous amount of movement happening in the 30-year Treasury rates in order to be able to get them up above that threshold. The other thing for this category of individuals is they use the ExxonMobil's 2000 mortality tables. So that's the year 2000. It has not been updated now in 20 years. So ultimately, people have been living longer. Now, we compare the grandfather category to the non-grandfather category. Now, the non-grandfather category is basically anybody who was under the age of 50 prior to December 31, 2007, or you were born after 1957 and hired after 1997. Now, for this age group, the math is actually much more complicated. So we're following 3 different segmented rates. They're all based off of high quality corporate bonds. Now, corporate bonds historically have always been higher than Treasury rates, and higher yields are worse. But these 3 segments are just deemed segment 1, segment 2, segment 3. Segment 1 is supposed to mirror the first 5 years of someone's retirement. Segment 2 is the next 15 years, so theoretically year 6 through 20. And then segment 3 is anything past that all the way up to the mortality age, which currently is set at age 84. Now, the other thing for this category of individuals is they use the IRS mortality table, which is updated every single year. So obviously, the longer someone's longevity is, the better, means higher the lump sum payment will be. Now, we did start seeing this category of folks retiring starting in 2013, and it is the predominant category at this point. Now, a couple things to talk about with relation to anybody that's in the all other category. The segments that are determined are only based upon the last 2 months of the preceding quarter. So, for example, June as well as May determined what is now the fourth quarter rate. April had no implication on it. Just like now, July has no implication on the first quarter of 2021 rates. It's only going to be determined based upon what happens in August and September. The other thing that we're seeing, and back to that real quick, thus far, what we've seen in the month of July is that the corporate bond yields are actually still on a downward trajectory, meaning we're going to see the discount rate come down. But to that exact point, it's just a projection. It's showing the trend. We're not able to determine what the official rates are going to be based on what's going on in July. So in terms of what rates are going to do in the first quarter, I'd like to hedge my bets. I'd like to have the option to go to first quarter if I can. But ultimately, we're not going to know those rates until really the second week of October when we get the official posted rates. Now, the IRS publishes these rates every single month. It's on their website. And one thing I'd say for both age groups and categories, every week we're sending out our projections. If you're not on that distribution list, please feel free, send me an email. I'll add you on the list. We'll include you to them. But what we're seeing in terms of comparison between grandfathered and non-grandfathered is with the grandfathered, obviously they have treasury rates, which the yields are lower on those, but the mortality table has not updated. Whereas with the non-grandfathered folks, it's based on these three segments. We have seen, obviously, the corporate yields are higher, but the mortality table has extended. So there's about 4 more years of life based upon the updated IRS mortality table. Now, one other nuance I want to bring up with relation to the all other category. The all other category, in order to take advantage of the benefit commencement date for that quarter, the discount rate for that quarter, your benefit commencement date also needs to be in that quarter. So for example, to get the fourth quarter rates, the last possible benefit commencement date for you will be December 1, 2020. So benefit commencement dates always have to be the first of the month, always. Your retirement date and last day of employment, they can be any other date within the month, but the benefit commencement date has to be the first of the month. So a lot of folks in this category don't know this. So if we're trying to target a fourth quarter retirement and take advantage of fourth quarter rates, which fourth quarter rates for both categories have been the lowest they've ever been, we need to plan for December 1, 2020. Now that said, I made the comment that we are seeing the trajectory of rates going lower. Well, since rates are on a trajectory of lower, I like to have the ability that if we can push into the first quarter of 2021 to look at taking advantage of those rates. All right, I've had a couple questions comes in. What is your speculation on discount rates for Q1 2021? Increase, decrease are the same as fourth quarter. I think I pretty much already answered that question. I think that for grandfathered folks, I think that the rates are going to stay flat at 1.25. For non-grandfathered folks, I do think that the trajectory is down. Our models, which again, it is very premature, but our models right now are showing actually an additional 30 basis point decline for the first quarter of 2021. All right. Is it possible to commit to a retirement date of fourth quarter 20, but delay specifically a BCD until first quarter of 21? Discount rate is announced mid-October. At that point, it would be too late to specify November 1 BCD, understanding payment would be delayed. All right, so the answer to your question in short terms is yes. So ultimately, you have in order to request a package, we have to do it 120 days out. So anybody who's got a November 1 BCD right now, we need to request those packages to get them in. Now, the formula for the ExxonMobil pension program itself is actually very simple. It's 1.6 times years of service times average pensionable pay. Now, at a certain income level, for 2020, it's $285,000 of compensation. If you're over that income level, you're subject to or eligible for what's called a supplemental pension plan. Also, if you're at the executive level, you're eligible for what's called an additional payments plan. The reason I'm going into this is because the supplemental pension plan as well as the additional payments plan, those are not allowed to be delayed. So if your BCD is November 1, 2020, then the supplemental, sometimes the acronym is SPP, and the additional payments plan, the acronym is APP. Both of those have to pay on November 1 in that example. Now, you do have the ability with the qualified portion, which is anything on your income below $285,000, to still retire, still have a November 1 BCD, but ultimately still delay taking that commencement into the fourth quarter. Now, to the exact point, we are going to know the official first quarter 2021 rates second week of October. Now, in order to get everything processed on time, your benefit commencement packages need to be back 35 days prior to your BCD. So what I'm telling a lot of folks for this November 1 timeline is go ahead, request the package. If you have an SPP and APP, we will pull out the required documents to send out back to benefits, which is the non-qualified pension election form and the direct deposit authorization form. We will submit those. If we do still continue to see the trajectory of rates going down, we'll hold on to the rest of the package. And by the way, if you're under the age of 60, ExxonMobil does impose a 5% per year discount. So ultimately, I still want to push it out either way. If we see rates staying flat or trending down, I want to continue to kick the can. If you're over 60, the math is a little different. We're happy to talk about your situation. But if I have the ability to delay, I absolutely do. And if we're seeing the trajectory of rates still continuing to trend down, I want to go ahead and hold off on the package. But the most critical date there will be September 27th, which is when those packages are required back in. So even by September 27th, we're going to have a very good indication of what the first quarter of 2021 rates are going to be. We won't have the official number until the second week of October. Ultimately, we still have the ability to just hold on to the package, submit it late, and to your exact point in this question, yes, you will have a delayed benefit given to you. Now, if we have to get to a situation where we need to re-request a package, you do have the right to work all the way up until November 30th, and then you can say you're going to retire and still take advantage of the fourth quarter rates if that's something you really want to do. Now, again, everyone's situation is going to be a little different, but you do have the ability to work all the way up to that date. Now, obviously, it puts the company in a tough spot, but you could then request a package. It's taking them 3 to 5 weeks to get these packages back. So by the time you get it, it's most likely going to end up being end of December, beginning of January. And then at that point in time, we can submit it, but you won't see checks cut until March 1 in that example. So I know I kind of went on a little bit tangent, but that helps explain it a little bit better. All right, changing gears here a little bit. The other thing that the Pension Protection Act did was it clarified 401k contributions as well as IRA contributions. So what we know for 2020 is if you're under the age of 50, you can do $19,500 into a 401k, whether it be pre-tax or you can do it in a Roth 401k. And if you're over the age of 50, you get to do an additional $6,500 of catch-up. Now, that said, you actually have the ability to do a total contribution of $57,000 if you're under the age of 50 and $63,500 if you're over the age of 50, excuse me. So what that means. So I'm just going to use the over 50 example just to make the math really simple. So we could put a total of $63,500 in. We're able to put $26,000 in on a pre-tax basis, right? So $19,500 plus $6,500, so that's $26,000 total. Let's just say your company match is $14,000 as an example. So that means that the total amount that went in is $40,000 for the year. That means that you can actually come back in and put an additional $23,500 into the plan on an after-tax basis. So you're not getting the benefit of deduction, but you can still get it in the plan, and that will build up what is called your tax paid credit balance. Now, the tax paid credit balance, we actually have some options on. I'll talk about in a little bit here in a minute. But it's something that we want to have from a planning perspective. If we have the ability to do some additional savings, like to see some after-tax money accumulating in the 401k. All right, with IRAs, IRAs as well as Roth IRAs. Now, the difference between an IRA and a Roth IRA is an IRA is money that you put money into, typically on a pre-tax basis. It grows completely tax deferred, and when you take the money out, you pay ordinary income on it. Roth IRAs, you put money in on an after-tax basis. It grows completely tax-free, and when you take the money out, it's completely tax-free, assuming you're over the age of 59 and a half, and that Roth's been in existence for 5 years. Now, you can probably imagine we're very biased. We'd like to see money in Roths. I have a whole presentation on this, but that said, from a contribution perspective, you're able to do $6,000 into it if you're under the age of 50, and an additional $1,000 of catch up if you're over the age of 50. Now, the difference with IRA versus Roth, in order to be able to get money into a Roth, there's really three ways of doing it. First is the Roth 401k. You have the ability within the savings plan to do Roth 401k. However, you're only able to do Roth 401k or pre-tax. So the rules applied here on this slide here, 19,500 or 6,500, it's either or. So if you're going to do Roth 401k, you're giving up the ability to put money in on a before tax basis. Now, everyone's situation is a little different, but for most employees, especially if they're the later stages of their careers, they're probably at the highest income level they're ever going to be at. And if that's the case, I typically would recommend seeing savings happen on a before tax basis. Let's reduce taxable income in the highest marginal bracket as opposed to putting money into a Roth 401k. Now, that takes that off the table. Now, the other ways of getting money into a Roth IRA are contributions and conversions. Now, contributions, if you're fortunate enough to be married and making over $206,000 of combined income, you're ineligible to do a Roth contribution. The only other way that you're able to get money into a Roth IRA is through conversions. Now, conversion is where you take money from an IRA and convert it over to the Roth IRA. And you're going to need to pay ordinary income on that conversion, but it's something that we should be talking about or looking at. Excuse me. Now, with the Roths, as I already mentioned, you get tax-free growth, you get tax-free withdrawals. The other big benefit with Roths, which I haven't talked about yet, is there are no required minimum distributions. So something to be very mindful of, especially for a lot of ExxonMobil households where, as we're doing some advanced planning, we start to see that required minimum distributions are going to become a problem. We should look at doing conversions of IRA over to Roths. The other thing that's nice about Roth IRAs is the beneficiaries inherit the money tax-free. Now, the Secure Act changed the rules at the end of 2019, where you are now, your heirs are now required to take money out over a 10-year period of time. Prior to the Secure Act, they were able to take it out and stretch it over their lifetime. That said, if it's a big IRA compared to a big Roth IRA, well, big IRA means that they're going to have to take it out and it's all ordinary income to them. So that means the kids are ultimately going to have to pay ordinary income. And if they're inheriting it towards the later ages of their career, where they're already at a higher income level, that means that the RMDs are going to be taxed at a higher level. Whereas with a Roth, they still have the 10-year rule, but they takes it out tax-free. So you can obviously notice that's another reason if we're able to use it to help manage your RMDs, bringing your taxable income down, but also the transition of wealth where it's going to the kids tax-free as well. That's another great example of why this makes sense. Roths also provide tax diversification. And as I already mentioned, there's some income limits that apply here. Now, one of the things that we like to do for those that are currently still working, and if they don't have any IRA account balances, we like to encourage something called backdoor Roth contributions. So the key here is you cannot have an existing IRA account balance. Most active employees, they don't have one, so this is something that's available to them. Now, if you have the ability to do the additional savings and you're over that $206,000 of income threshold, this is a fantastic strategy. And by the way, it's a great strategy if you're considering hiring an advisor, have them do this for you as well. But with the backdoor Roth, what it is you actually can put money into an IRA and we do not take a deduction on it. That's the most critical part of this. So because you're over the income threshold, you're not even going to be eligible to deduct it, but you can put money in on an after-tax basis and then immediately convert it over to Roth. So with Roth conversions, there are no income thresholds on how much you can convert, which by the way, that's a rule that changed in 2010. Prior to 2010, the income threshold was 100 grand. They got rid of it and they haven't ever added it back. So this backdoor Roth strategy is a fantastic way if you have some discretionary cash or you want to try an advisor out or whatever, consider doing this. Get the money growing tax-free, ultimately start that 5-year clock as well. Now, there is no limitation on the amount of conversions you can do each year. So some people, whether it's this backdoor strategy or if we're already in retirement mode and we're in a low income bracket and we want to start doing conversions from the IRAs to the Roths, there is no amount that we're limited in terms of the number of times each year. Now, if we need to reverse it, that's a separate conversation. We're not able to do what's called a recharacterization anymore. That's something that also changed as part of the Secure Act at the end of the year. So if we're going to do a conversion, we want to be very deliberate in how we're doing it and ultimately know what all the tax implications are going to be because of what's happening. Like a great just kind of situational experience share. What's happened in the early part of 2020 with the market volatility from COVID? Anybody who was in this conversion mode, we were real big, get conversions done now while things are down, because we did believe at some point, we didn't know when, obviously, but at some point things were going to recover. And ultimately in March, we were plowing, trying to get as much as we could do in terms of conversions, but we still had to be careful of what the overall tax implications were going to be, because throughout a year, tax variabilities can exist, and we don't want to do something that's going to intentionally drive you into a higher tax bracket. That said, if we could incrementally do an amount for conversions while things were down and then let them recover, because all that growth is now in the Roth, tax-free, whereas if it recovered in the IRA, it was still tax-deferred, and then we would need to convert it. Now, for a lot of clients that's in that situation, we did a tranche, and then we're going to true it up at the end of the year once we have full visibility of what their tax situation looks like. But back to the backdoor Roth, while you're still actively employed, this is a fantastic way of getting some money set aside and growing. I had a question. For the backdoor Roth IRA, I can't have an IRA account. Please explain. Okay, thank you for asking that. That's actually a great question. So the reason that the backdoor Roth works with no IRA, if you do not have an IRA account balance, is because of that conversion piece. So if you have an existing IRA, and I'll make the numbers up. Let's just say you've got $10,000 in an existing IRA. And let's say you want to go ahead and do this backdoor Roth conversation. Well, if you put7,000 in, so now the total balance is 17,000, because you had before tax money in the IRA, when you do the conversion, only 7/17 of it is considered tax-free. Now, ultimately, you could make the decision to convert the entire amount over, but that initial 10,000 will become a taxable ordinary income event. And that doesn't always make sense, especially for somebody who's actively employed and at a higher level. Now, that said, planning opportunity for kids, especially if kids are on an upward trajectory of income and early on in their career, they might have put money into a 401k or started establishing an IRA. You know, if the kid goes back to, get their MBA or law school or something like that, where their taxable income is going to drop, well, those are the years. Let's convert IRA or pre-tax money over to Roths, free up the ability to get this backdoor strategy, something that's back to available to them. Another great example was when I got married. Prior to my wife and I getting married, I wanted to have the ability to do the backdoor for both of us. Right before we got married, while she was still single, we went ahead and converted the IRA to the Roth. That then freed up the ability for us to do the backdoor for her from this point forward. So thank you for asking that question. Great question. All right. I'm going to transition a little bit. I want to talk about available options within the ExxonMobil savings plan. And I'm going to move somewhat quick through some of this because I want to make sure I'm getting to stuff on the back end without being too long in duration of this presentation. So we know within the 401k, you've got ExxonMobil stock, you have equity units, extended units, international units, bond units, balance fund units, and common assets. Now, as we know, ExxonMobil stock has not performed well over the last 10 years. It's single stock, so it does have higher implicit risk, but it does provide the opportunity for net unrealized appreciation. Now, I do have an entire presentation. It's recorded. It's on my website for NUA if you'd like to watch it. But what I would say, just at a high level of introduction, NUA is a tax strategy that if you have low cost basis shares, and most of you will if you were around during the merger, it's something that we want to consider taking advantage of. Now, again, it's a strategy. It's not the end all be all, but part of who we are and what we do is finding ways to save money in taxes. And so this is a great example of this. If we don't do NUA and we just left everything in the savings plan or rolled it all to an IRA, when you take it out, you pay ordinary income. With NUA, you're going to pay ordinary income on the cost basis. All of the gain is going to be at long-term capital gains rates. So at the highest level, what NUA is it's playing the difference between ordinary income rates and long-term capital gains rates. Again, I've got a whole presentation on that. Please feel free to view that one. Here's just an image of the savings plan statement. And specifically, one of the things that we want to be looking at is how much you have in after tax. Remember earlier I made that comment about tax paid. So we're specifically talking about your pre-87, post-86. And it's listed here as a separate bucket. This is an individual that's done a lot of after-tax savings in their 401k. This is a very different number, by the way, than what's listed under after tax. After tax includes all of the appreciation. Now, the reason this matters is because we can use that tax paid credit balance in a lot of different ways. With regards to the NUA, we're going to specifically look at what the low basis share tranches are to then determine what's appropriate to utilize for NUA purposes. The other thing that we want to look at is where you're making contributions. So, for example, most of those who are over the age of 50 don't know that they need to go in and actually add their catch-up contribution in. So if you're not doing catch-up contributions, it looks a lot like this. This person had 11% going in on a before tax basis, nothing to Roth, nothing after tax. But if they're under 50, obviously you don't have the ability to do it. But if you're over 50 and you don't see that catch-up contribution line listed, that means you're not doing it. It should look something like this. And the difference is, by the way, catch-up contributions are listed as a specific dollar, whereas pre-tax contributions or even Roth 401k are listed as a percentage. So if you're over 50, definitely want to get that going. Highly recommend that. Now, taking a quick step back to the tax paid credit balance, the reason this matters is there's three options available to it. When you retire, you actually can withdraw it, use it for cash flow purposes. You can use it to offset against the cost basis of the NUA share. So if you remember in this example here, I made the comment that you pay ordinary income on the basis. So you can use that tax paid to offset that ordinary income effect. And the third is you can actually roll it over to a Roth IRA. Now, there is the ability to do it while you're still actively employed. You can do what's called an in-service withdrawal to take tax paid out. You have to take the gain as well, but you can get it into a Roth. The reason this matters is because we want that money growing tax-free, whereas while it's in the savings plan, all of the growth is on a pre-tax basis. All right, quick tangent there. Equity units as an investment option, these are tracking the S&P 500. It's 500 of the largest U.S. companies. It represents 70 to 80% of the market value of publicly traded companies. The extended units is approximately the Wilshire 4500 index. It's targeting selecting mid and small cap companies. So it's an index that includes all publicly traded U.S. companies minus the S&P 500. The international units is tracking the EFI index. It's large and mid-cap companies in 21 developed countries, specifically Australia, Austria, Belgium, Denmark, Finland, France, Germany, Hong Kong, Ireland, Israel, Italy, Japan, the Netherlands, New Zealand, Norway, Portugal, Singapore, Spain, Sweden, Switzerland, UK. It's currently made up of 918 companies, and it represents approximately 85% of the market capitalization of those countries. And then we have bond units. Now, bond units is tracking the Barclays Capital Aggregate Index. Represents 17,000 bonds publicly traded in the U.S. It's a mix of government, corporate, and mortgage bonds. It does not include high yield bonds, municipal bonds, inflation index bonds, and bonds denominated in non-U.S. currency. One quick comment that I would make about bond units. I am not a big advocate for bond units in the savings plan. And the main reason for that is because, especially now, and by the way, I've been saying this for 2 years, and I've actually been slightly wrong with that, and I'll admit it. But for the last couple of years, interest rates have been rock bottom low. And in this COVID environment, they've come down even lower. At some point in here, interest rates are going to rise. And if I had to guess, based on the amount of money we've printed, rates are going to move up quickly when they do start to do that. Bond units, because bond prices and interest rates move inverse to each other, as interest rates have come down, the value of the bond units has gone up. But at some point, as I just said, interest rates are going to go up, which is going to hurt the value of these bond units. The other part of it is as we look at a household's asset allocation in its entirety, we have to look at everything, including the 401k, but also that pension lump sum option. And so, for example, if your pension lump sum is $1 million and your 401k is $1 million, well, your lump sum pension program is a big bond portfolio, very subject to interest rates. So as we know with these discount rates, as rates go down, our lump sum goes up. If rates go up, our lump sum goes down. Well, that's bond portfolio. So even if your 401k is 100% invested in stocks, your overall allocation is 50-50. So it's important when we're looking at investment structure, how we're allocated, make sure you factor in the value of that pension lump sum. And because of that, it's another reason why I'm not a huge fan of bond units in the 401k. Now, the balanced unit is kind of the one-stop shop for an investor who just doesn't really want to have to think about it. It's made up of 35% equity units, 15% extended, 25% international, 25% bond units. Same reason I just listed on bond units. I'm not a huge fan of balance units, but if you just want simplification and get it done, it's not a bad option. And then lastly is common assets. Common assets is your safe cash equivalent bucket. It does have a variable yield. That yield's been coming down just like every other money market right now. That said, common assets is one of the best money markets you're going to find. It's not a bad place if we're parking cash, get it sitting over there. We did include just kind of rates of return. Chart's a little fuzzy here, but these are as of the end of the year. You can pull it right off of the ExxonMobil Voya website. But you can see various different return numbers. You know, stock's been underperforming pretty much everything for the last several years. You know, definitely a conversation of your allocation that we should be having. All right, so while we're in this phase, we definitely need to be evaluating contributions. First off, how much, where we're allocating them towards, if they're before tax versus they're after tax, and ultimately if we're accumulating some of that tax paid credit balance. That's definitely something we should be doing when we're well over a year out. We should be doing it even within a year out. And then next up, we need to talk about the pension program. I've already talked about the pension a lot today, but really what this slide is, it's an old slide. It's actually from 2007. It's the old legacy pension calculation tool. But the reason I like it is because it shows the calculation itself. So we know ExxonMobil pension programs 1.6 times years of service times average pensionable pay. There's a little bit of a Social Security offset, but that's what gives us the single life annuity option. So I like showing the formula there. But ultimately, we do need to make the decision with regards to the pension lump sum if we're going to take the annuity or if we're going to take the lump sum. Now, if we take the annuity, which it's a very phenomenal option in the sense that we're getting a guaranteed payment for the rest of their life. There are some risks with it though. First off, there's no cost of living adjustment on the annuity program from ExxonMobil. Second off, if you happen to predecease early, whatever that lump would have been otherwise, potentially going to be less. Now, there are period certain options within the annuity program to hedge that risk. But if it's something that you're really concerned about legacy, I'm going to make a very strong and compelling argument that you might want to consider not necessarily going 100% annuity. The beauty of the ExxonMobil pension program, though, is that you're not forced to do 100% lump sum or 100% annuity. It used to be that way. Now you can do 75-25 either directions. You can do 50-50. It does provide a tremendous amount of flexibility that as we're building out a client's risk profile, we can determine what would be appropriate for you. Now, just real quick side note, and I mentioned this earlier, if you have a supplemental pension plan or an additional payments plan, those are not eligible for an annuity option. There's have to be a lump sum and they are taxable. So make sure that we're preparing for that. Someone asked if this is on the website. This one, not yet. It will be. I'm recording it right now. We'll be posting it as soon as I finish this talk. And we can email it out as well. All right, now savings plan options. You do have some options with regards to what to do with the savings plan. What I always tell folks is the default is leave it there. And if you're even postulating on what you want to do with 401k, leave the savings plan at Voya. It's not a bad investment platform by any means. You know, the only criticisms that I can have on the 401k is that you're limited in options and that you can only do 2 trades a month and you only get the average price the following day. But while you're in the accumulation mode of life and we're just looking for low cost investment options, the 401k is a great platform for that. That said, when you're ready to take the money out of it, you have some flexibility there as well. First, you can actually take it as an annuity. Never seen that happen, but you can do it. You can do what's called a lump sum distribution, and then you can roll the whole thing over to an IRA. Now, the lump sum distribution is the option which allows the NUA, net unrealized appreciation. And with that, with the lump sum distribution option, you can take it out as 100% cash. Never seen that either, because that would be 100% taxable. You could also roll it all over to an IRA, and you can have the ability to take stock out in kind. So, and that's typically where we have the NUA, and then if you have any other stock that we want to roll over to an IRA account, you can do that as well. And here's just a real quick example of the typical flow chart that we see for a 401k, where we'll have a portion of shares that come out to an after-tax account. So it might be a joint account, individual account, trust account. Then we more often than not have shares that come out as shares. They go to an IRA account. And then anything else, equity units, extended units, international units, common assets, bound units, those get cashed in and go to an IRA account. No tax implications because they're going to the IRA. And then lastly, if you have any Roth 401k or excess tax paid, those go over into a Roth IRA as well. All right. Now, when it comes to rollover options, frankly, this is where people ask the questions, why should I take it out of the savings plan? Why? Same thing I'd say before, more available investment options. You do have the ability, if you want an advisor helping or professional money management, you can do that. But ultimately, it does give us a lot more flexibility. In this age of low cost investment platforms, I would say that the cost differential has been somewhat negated in terms of the benefit. I would personally believe I'd rather have options, more flexibility, and being able to strategically target prices that I want to sell or execute at, as opposed to getting the average price the following day. Most end up doing rollovers. We're seeing about $200 billion annually is being rolled over, 548 million daily, $22 million hourly. All right, now transitioning a little bit, when you're over a year out, we need to identify investment sources, where they're coming from, how we're structuring it. And this is where we have to talk about the options that are available to you. Now, Social Security is an option, and you do need to embrace that Social Security will be there. I do believe there will be reform in the future. But that said, Social Security was never designed to replace 100% of anyone's income stream. On low income thresholds, it was 90%. And theoretically, if you have an unlimited income, it's less than 1%, right? I'd love to meet you, by the way. But for the U.S. median, typically replaces about 40% of their income needs. For the typical ExxonMobil employee, it's anywhere from 10 to 30%. The next income source is pension program. Now, the pension program also not designed to replace 100% of anyone's income. On the low end, it's 12%, and that's typically somebody who's had 15 years of service and retiring right at age 55. On the high end, it's up to 70%. But again, we talked about the formula. It's just 1.6 times years of service times average pensionable pay. For the typical career ExxonMobil employee, we find if they're retiring at 60, it's somewhere around 50%. So let's just say you're retiring at 60 and you've got 50% coming in from the pension program. Let's say you've got 10% coming in from Social Security. That's 60% of your income needs. I don't know a whole lot of people who retire and want to live on 60% of what they were living on before. And so because of that, the delta needs to get filled with savings and other investments. And that's why we talk about all of other options available to you. All right, now cash flow planning. Cash flow planning is where you really need to have an understanding of how are we going to generate income off of these different investment programs and what income sources you have available to you. So I already mentioned Social Security, I already mentioned pension income, but we're real big believers in understanding cash flows at a much higher level. So where's our short-term liquidity buckets coming from? And then what are the income flows that we're having from different types of investment structures, whether it's bond ladders, whether it's different types of income paying investment options. Might be corporate bonds, it might be mortgage bonds, it might be dividend paying stocks. It might even be covered call writing if you've got a couple shares of ExxonMobil stock. Got a whole webinar talking about covered calls as well. And then part of this plan also needs to incorporate tax planning. And so one of our core competencies is understanding tax optimization. And again, the ultimate objective is to keep more money in your pocket. But in order to do so, you need to understand the tax implications associated with the different types of income sources. So for example, Social Security, typically 85% of it's treated as ordinary income. Pension income, interest income, and then any distributions from an IRA or 401k, they're all treated as ordinary income. Qualified dividend income as well as long-term capital gains rates are all at long-term capital gains rates. We'll talk about that in a second. Roth IRAs, not subject to tax, assuming you're over 59 and a half and it's been in existence for over 5 years. And then liquidation of investment principal, also not subject to tax. So long-term capital gains rates, we know that marginal capital gains rates go from 10 to 12 to 22 to 24 to 32 to 35 to 37. We also know that long-term capital gains rates go from 0 to 15 to 18.8 to 23.8. So the point with this is, let's optimize. Now, most employees, while they're working, you have ordinary income, you're at whatever your marginal tax rate is, that's great. But once you've retired, one of the things you have to embrace is this is the first time probably since you started working, where we can determine where your taxable events are occurring. So we have the choice. Do we take money out of an IRA account, or do we live on other assets that you might have available to you? It might be money that's sitting in checking or savings or money market accounts. It might even be some of those net unrealized appreciation shares, because again, they're now in an after-tax account. And if we have the ability to bring your tax bracket down to a very, very low level, well, one of the strategies we should be looking at considering is selling assets that are at a gain for 0% capital gains rates. I mean, why not? And if we can be in a situation where we can get stock out of the 401k and pay nothing to do it, and then ultimately do some planning to sell it and not pay anything on the gain, that's a pretty good move. Same conversation, though, goes with Roth conversion strategies. If you're in a position where, again, you can determine what your taxable income is, and for a period of time in your retirement where we can bring your taxable income down very, very low, why not look at converting portions of the IRA accounts over to the Roth accounts so that all of that growth is happening tax-free? It's also not going to be subject to required minimum distributions. Those are just some basic planning strategies that when we talk about tax optimization, it's absolutely imperative that we're incorporating in there. Now, there's another nuance that has to be factored in is for anybody who's retiring under the age of 59 and a half. Now, the reason this matters is because when you're under 59 and a half, there's a 10% penalty to take money out of retirement accounts. Little asterisks, obviously in 2020, there's some flexibility because of the CARES Act, but in a typical year, 10% penalty. So in order to do that planning, we need to understand what are the different buckets of money we have available to us. It might be savings. It might be some of that net unrealized appreciation stock. It might be part-time work or consulting. We also have the ability to leave the 401k at Voya, and once a year, we can take money out penalty-free. Still pay ordinary income, but we can take it out penalty-free. There's also a tax provision called a 72T, where we can structure essentially a 5-year annuity payment off of an IRA account. It stands for substantially equally periodic payments. So for 5 years, you have to take out the exact same amount from a retirement account, but it is an option to avoid paying a penalty. And then last option, it's not my favorite, but it's an option, is using lines of credit, whether it's margin off of your portfolio or lines of credit on your house. But ultimately, if we're trying to avoid paying a 10% penalty, what's the harm in borrowing? I mean, lines of credit right now are at like 1.25%, 1.5%. Borrowing short term in order to prevent us from having to sell Exxon while it's down, or if we're just trying to get to 59 and a half, it's an option available to us as well. But the point is, it's very, very complicated. And we really need to be pulling all of the various different pieces together, whether it's taxes, risk management, estate planning, insurance needs, investments, and beyond all of that, we've got to deal with market forces and the laws that are changing. So Bogart Wealth's core competencies are financial planning, investment management, tax optimization, and tax preparation. I do believe that all 4 of them need to be seamlessly integrated into anyone's financial plan. And I think any advisor that you're considering also needs to be doing that as well. Now, as we're talking about why spending is so important, it's important to understand where or what your actual withdrawal rate is. And this is one of those tools that we're using to help us monitor how we're doing in terms of overall success. And the reason is, and this is a hypothetical illustration, but to kind of show the point, if we have an investment portfolio that's returning 5% per year, let's just say inflation's at 2%. Well, if you're withdrawing 3% of your portfolio, it looks like it goes on forever. It's actually not the case, but sustainability of a 3% withdrawal rate on a portfolio is 99 years. For somebody who's withdrawing at 4%, portfolio is 43 years. 5% is 29, 6% is 22, 7% is 18, 8% is right around 15%, or 15 years. So the point is if you're retiring at 60 and you're withdrawing at 4%, well, sustainability is 43 years. We're probably going to be okay. But if we're higher than that, we need to really have a discussion and understand the why. And it's not uncommon, by the way. We might, for example, if we're retiring at 60, we're not taking Social Security for a few more years. Well, we might have a higher withdrawal rate while we're waiting for that cash flow bucket to come in, as an example. There are various different reasons. But as you're doing this analysis, we definitely think it's important to understand cash flows. We understand if we're needing to bridge, for example. We need to be doing the analysis around annuity versus lump sum. We need to do the analysis around how to optimize that net unrealized appreciation. looking at your overall portfolio and investment allocation to making sure it's in line with your risk profile. You need to be looking at the Roth analysis as well as any type of tax implication and tax optimization to be doing within your overall plan. Looking at your insurance needs, whether it's long-term care or if you need life insurance, those types of things also need to be incorporated. And lastly is Social Security, and making sure that we're optimizing there. Now, we do get the question a lot of what should you be looking for in an advisor. This is our list, and what I think is important. It mirrors very close to what Ernst & Young publishes in your late career retirement course. But I do believe that if you're looking at hiring an advisor, they need to be a fiduciary. And what a fiduciary is we're legally obligated to put your interest above our own. There's not going to be conflicts of interest in a relationship. There's no hidden fees. There's no hidden agendas. We also think that they need to be certified financial planners. They need to know the ExxonMobil retirement programs, because the ExxonMobil retirement programs are unique from several other companies' plans. And there are nuances in there that really can make or break the amount of money that's transitioning to you. They need to know the IRS rules, really specifically net unrealized depreciation and some of these Roth conversion strategies. We believe they should have over 15 years of experience, that they manage their own portfolio, that they're not farming it out to an outside money manager. We also think that they need to be able to discuss various different investment options as well as strategies. You know, it's all well and good if an advisor knows their one thing, but really at any point in time, the landscape changes. We need to be able to talk about different strategies in order to adapt to those environments. We do believe it's important to track your plan versus the actual results, because at the end of the day, what's the point of planning? And for us, planning is the epicenter of a lot of the decisions that we are making, not only this year, but in future years as well. And then lastly, are they understandable? Are they good translators for you? So this is our list, by the way. You know, you can add things to it, but the one that I can't emphasize enough is this fiduciary model. And I believe that fee only is without a doubt the way to go. And you know, again, I might be slightly biased, but that's the way I set up the firm. I wanted it to be the way I'd want my family to be working with an advisor. All right, in any case, let's transition. I want to talk a little bit about less than a year out. Now, it's not going to be anywhere near as long as what I've already gone through, and I'm going to move somewhat quickly. But when we're less than a year out, this is when we really need to determine and refine your income need. If you haven't done so yet, consider hiring an advisor if you're going to be using one, using trial accounts. I've talked about that. Determine your cash flow plan. How are we going to determine or generate your paycheck? We want to understand if we're under 59 and a half, how we're going to be handling that. We want to review possible investment plans as well as withdrawal strategies. This is when we really need to be watching the discount rates, understand year-end leave situation and overall work situation. And then when we get to that point of 120 days out, this is when we're kind of what I call execution mode. I use the football analogy. We're in the red zone. We want to make sure that we don't have any fumbles. We don't want any interceptions. We want to make sure that we're executing flawlessly. We need to understand the 3 key dates. So last day on the payroll, first day of retirement, and benefit commencement date. Now, as I mentioned earlier, benefit commencement date has to be the first of a month. The other 2 dates, first day of retirement and last day on the payroll, they can be any other day in the month. Now, again, at 120 days out, that's the earliest that you're going to be eligible to request a package. And that's where we can request the intent to retire package. We inform our supervisor of the key dates in writing. They do submit the SMART forms. If you have pay in lieu of vacation, we'll also get that form and we'll want to submit that. And then at that point in time, we'll want to receive and return the intent to retire package. Now, this package needs to be back 35 days prior to the benefit commencement date. So if your BCD is 11/1, we need the package back absolutely no later than September 27th. And then typically when you're in this timeline, we want to plan our retirement party. It's a little hard during COVID, but that's when we start doing it. You turn in the laptop badge over the lice, etc. Now, when it comes to the package, the intent to retire package does contain a lot of information. It's about half an inch thick. On the benefits website, they have a link. You can go see an example of one. But it includes all of the information related to your healthcare and any of the available options to you, but it's not allowing you to change it. The benefits package is specifically designed to really select the lump sum versus annuity option. Now, when you're completing this package, I think it's imperative. You got to do it with your advisor. Ultimately, our firm, we've done hundreds of these. This is the first time you've done it, and we are making some irreversible life decisions. But this is where we're going to select lump sum versus annuity. If we're doing the annuity, we need to choose which annuity type you're doing, and then also what the tax withholdings are going to be. If we're doing a lump sum, we need to select an IRA custodian. As I mentioned, we want the advisor to verify it all. In that package, by the way, is a special tax notice. You're going to want to read that because ultimately you're going to have to acknowledge that you've read and received it. Now, if the normal package, if you're under the income level of $285,000, there's going to be two places that the employee needs to have notarized, one that the spouse needs to be notarized. If you're single, it's only the two. Now, if you have an SPP and an APP, there's an additional series of documents that we need to be doing as well. Now, as I mentioned, this needs to be back 35 days prior. And I've had a question come in. Isn't the first day of retirement the day after last day on the payroll? Yes, it is. But theoretically, they don't have to be 3 separate days. You can have first day of, you can have last day on the payroll be one day. Your first day of retirement can also be the same day as your benefit commencement date, as an example. All right. Now, a lot of folks ask us the question of when should they consider delaying taking the pension? Well, first off, if you don't need the money right away. Second off, if you're under the age of 60, and the reason for that is, as I mentioned earlier, ExxonMobil imposes a discount prior to the age of 60. It's about 5% a year. And if we're going to take the lump sum and we're seeing interest rates going down. So a lot of times right now, as I'm having these discussions, especially for anyone who's going on November 1st, if you're under 60, I really like still looking at December 1 for the BCD on the qualified portion. The reason is because it's one less month of discount, but it also buys us the flexibility and timing to know what the first quarter of 2021 rates are going to be officially. Right now, we know the trajectory, but if they do end up going down, we're going to kick the can at least until January 1st, but more often than not, it'll be March 1st. And but ultimately, if you're taking the annuity, who cares what interest rates are doing? That's more of a cash flow discussion than anything else. We don't need to worry about what rates are doing. Happy to talk about your situation one-on-one as well. All right, so talking a little bit about right at retirement, and this is where we start transitioning. First thing, as you retire, right around your BCD, when the lump sum check comes in, we need to get deposited in the IRA accounts. And then we need to have a conversation around your savings plan. Now, as I mentioned earlier, the default with 401k, leave it at Voya. That is without a doubt something that we want to be mindful of. But if we're getting ready to do the savings plan, we want to make sure that we do not do any withdrawals or Roth conversions prior to the rollover, because that could make implications for other parts of the plan. We want to be very clear with what our strategy is with the savings plan. We want to understand in conjunction with your cash flow plan, with your net unrealized appreciation plan, in conjunction with all of the tax implications that we may or may not have. Let's also review it in conjunction with your estate plan, your investment plan, and then review all of the calls prior to making the rollover call to Voya. Now, when we do the rollover call to Voya, we have to wait a couple days. Typically, I recommend a week after your last day of employment before we can call Voya and do it. Now, Voya first is going to review to verify that you're eligible, so that your retirement date's in the system. If you happen to have a quadro, which is a qualified domestic relations orders, if you've been divorced, they're making sure that that's been released. And then at some point in there, the representative at Voya is going to verify that you've read and received that special tax notice. Now, once we've done all of the administrative work, that's when we then can convey to them how many shares are we going to do for NUA, what we want to do with any remaining shares. We're going to verify who the IRA is and address and account numbers, and then what we want to do with any of the after tax. So we'll do all of this with the first person, and then typically we sit on hold for anywhere from 15 to 45 minutes and get the distribution specialist. I'm being somewhat cynical, but the hold times have been relatively long lately. But one thing that I would say is you got to have an advisor on the phone for this call. From my experience, I'd probably say close to 70% of these calls have been wrong lately. And I think it's really important to have somebody who knows how to identify the errors. Again, my firm, we've done hundreds of these, but there's been a lot of errors coming out of Voya with these, and whether it's because of staying at home, whatever, there's only a few of the distribution specialists that I actually think will get it done right at this point. But even after you've done the call, you want to make sure that when you get all that distribution documentation, have your advisor review that as well. Because even if I've had a call that's gone seamlessly smooth and we've gotten everything correct, that doesn't mean that what they report in the system is actually correct. So have the advisor verify. And if there's a mistake, we want to make sure that we go back and get it fixed before the end of the calendar year, because we don't want that to be shown up on the tax documents. That makes it a lot more difficult to get everything fixed. All right. So have an advisor. You know, definitely there's a lot of choices, things that we need to be incorporating, and have a plan. If there's any big takeaway that I could give you from today, it's pull all the pieces together, get a plan done. You know, lots of firms will do plans for you. Again, we do it at absolutely no cost and absolutely no obligation. Here is our contact information. I apologize, I went a little longer than I would have wanted to today. Any one of us is available to be a resource for you. Please feel free, fill out the survey at the end of the call. Watch any of our webinars that are on the website. If there's a topic you'd like to hear us talk about, I'd really love to be able to do it. Oh, I had a question come in. How long can investments stay in Voya after retirement? Oh, I'm so glad you asked that question. So to repeat it, the question was, how long can you leave things at Voya? The answer is there is no definitive timeline on how long you can leave it there. Theoretically, you can leave it the rest of your life. Now, when required minimum distribution age comes up, typically Voya will give you a notice they'd like you to pull it out. But if you have net unrealized appreciation stock, some of that low basis stock, you definitely want to get it out before then, because ultimately, if you're over the age of 59 and a half, and this is something I talk about in the NUA webinar, but if you're over the age of 59 and a half and you take money out of Voya, well, that'll kill your ability to do NUA. So with NUA, you have to do what's called a full lump sum distribution all in 1 year, 1 calendar year. And if there's any distributions prior to that, that'll kill the ability to do NUA. So something we want to make sure we're discussing in conjunction with the overall plan. The other thing is if you have Roth 401k in the savings plan, Roth 401ks actually have RMDs, whereas Roth IRAs do not. So that's the other thing. Typically prior to 72, if you have Roth 401k, get it out. And then if you also have tax paid credit balance, I typically see folks rolling them out of Voya simply so that we can get it over into a Roth, because while that tax paid is in the 401k, it's growing tax deferred. Once it's out and over into a Roth IRA, it's growing tax free. So glad you asked that question. Kind of pull a lot of that together in a lot of different presentations we do. All right, so again, here's all of our contact information. I know Mindy's going to follow up and reach out and just thank everyone for attending. But if there's anything you need at all, please feel free to reach out. We're a resource for you. And thank you again for taking some time today. We're also recording it. Feel free to send this out to any of your colleagues. Thank you much. Stay healthy, stay well.